If you ever sold stock, real estate, cryptocurrency, or even a business asset and made money from it, you may have triggered something called a capital gains. And here's the reality of it: most people don't plan for the tax side of that gain until it's too late. Welcome back to the channel. I'm Joe, a licensed certified public accountant with over 10 years' experience in corporate and public accounting. I have an extensive background in accounting, audits, and taxes, and I'm all about helping you take control of your money and live smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And check out our blog site where we post every Monday, Wednesday, and Friday. Today, I'm breaking down what capital gains taxes are, how they're calculated, and the difference between short term and long term gains, and most importantly, how to legally reduce what you owe. Let's get into it. Capital gains happens when you sell an asset for more than what you paid for that asset. That asset could be stocks, real estate, cryptocurrency, mutual funds, and business property. So the formula for calculating your capital gains is going to be your selling price minus your adjusted basis. And we'll get into what adjusted basis is a little later in the video. So capital gains are taxed by the IRS. And remember, the IRS doesn't tax the profit, not the full sales amount. Here's a quick example. Let's say you buy stock for $10,000 and then you later sell that same stock for $18,000. Your capital gains will be $8,000. So the IRS doesn't tax the full $18,000. They only tax the $8,000 profit. That profit is your capital gain. Now here's where it gets important. Not all capital gains are taxed the same. The amount of tax you pay depends largely on how long you held the asset. Let's talk about how capital gains are calculated and also talk about that term that I used earlier, adjusted basis. Remember the formula I showed you earlier. It's going to be the selling price minus your adjusted basis equals your capital gains. So let's talk about what your bases are. Your basis starts with what you paid for the asset, but it could change. For real estate, for example, your basis may increase if you added a new roof, remodeled a kitchen, or added square footage. Those improvements increase your basis, which lowers your taxable gain. On the other hand, if you claim depreciation on rental or business property, your basis may decrease. That's why record keeping is critical. The difference between what you paid and what your adjusted basis is can dramatically affect your tax bill. Selling your personal home has some special rules to it. If you sell your primary residency, you may qualify for an exclusion. You can exclude up to $250,000 of gains if you're single, or up to $500,000 if you're married filing jointly. But to qualify, you must generally have owned the home for at least 2 of the last 5 years, lived in it as your primary residency for 2 of the last 5 years. This is one of the most powerful tax benefits available to homeowners. Now, if you're selling a rental or investment property, that's different. There's no automatic exclusion. And the depreciation you claimed over the years may be subject to something called depreciation recapture, which can be taxed up to 25%. However, strategies like the 1031 exchange may allow you to defer the gains by reinvesting into another qualifying property. This is where planning becomes critical. High income taxpayers may also be subject to an additional 3.8% tax. That's called the net investment income tax. If your income exceeds a certain threshold, this applies on top of capital gains tax. So, in some cases, someone might pay 20% long term capital gains plus 3.8% of the net investment income tax, which brings them close to 24%. That's why understanding your full tax picture is important before selling major assets. Here's some good news: capital losses can offset capital gains. If you sell an investment at a loss, you can use it to offset gains from other investments. If the losses exceed the gains, you can offset up to $3,000 of ordinary income per year. The remaining loss is carried forward into future years. This strategy is often called tax loss harvesting. Used strategically, it can significantly reduce your overall tax liability. Here are practical ways to reduce your capital gains tax. Hold an asset longer than 1 year when possible. Time sales in lower income years. Use only tax loss harvesting strategically. Maximize retirement contributions to reduce taxable income. Consider installment sales for larger transactions. Use the 1031 exchange for investment real estates. The key takeaway: capital gains tax are not just about what you earn, they're about how you plan. Too many people make investment decisions without considering tax consequences, and that can be expensive. If you're thinking about selling stock, real estate, cryptocurrency, or a business, don't wait until tax season to understand the impact. Plan before the sale, not after. If this video helped you to understand capital gains taxes better, be sure to hit the like and subscribe button and share it with someone who needs to hear this. And remember, as always, smart tax planning isn't about avoiding taxes, it's about managing them wisely. And be sure to come back next week where we'll talk about how the IRS flags red flags.